All right, let's talk about Broadcom. Now, you probably know them as a chip company, right? Well, they've been quietly pulling off one of the most aggressive transformations in tech. And depending on who you ask, it's either totally brilliant or completely brutal. We're going to break down exactly how they did it.
So, first, just look at this number, $580 billion. As of May 2024, that was Broadcom's market cap. We're talking about a company playing in the same league as Meta and Tesla. It's a massive, massive valuation. But the really wild part isn't just the size, it's the story of how they got there.
And this chart, this kind of tells you everything you need to know. You see that huge chunk, 42%? That's all infrastructure software. For a company that built its name on silicon, this is a mind-blowing shift. They're practically a 50-50 hardware and software company now, which is it's almost unheard of at this scale.
So yeah, that leads us to the big question, the one we're here to answer. How in the world did a semiconductor company manage to build a software empire that pulls in over $21 billion a year? Let me tell you, this was no accident. This was a deliberate, calculated, and incredibly high-stakes pivot.
The whole thing really boils down to a super methodical three-pillar strategy. See, Broadcom's leadership looked at the hardware market and saw this brutal up-and-down cycle, where today's cutting-edge chip is tomorrow's commodity. They knew they needed an escape hatch. They wanted stability, predictable profits, and high margins. And they realized the answer was software.
And here is the playbook. This is the roadmap for that entire transformation. These are the three pillars we're going to walk through. First, they basically bought their way into the software game. Second, they proved they could actually add value. And third, well, they completely changed the rules for how customers have to pay. Let's jump into pillar one.
So, the first move in Broadcom's master plan, a massive shopping spree. But here's the thing. They didn't chase the flashy, cool, high-growth startups. No, they did the exact opposite. They went out and bought the established, mature, and let's be honest, kinda unsexy giants of the enterprise software world.
And just look at the price tags here. These are not small bets. We're talking about nearly $100 billion spent to buy companies that were already deeply, deeply woven into the fabric of the world's biggest corporations. CA Technologies, Symantec's enterprise business, and the absolute crown jewel, VMware, for $69 billion. They weren't buying potential, they were buying incumbency.
And here's why that was so smart. Each one of these companies came with a built-in customer list of the Global 2000. We're talking the biggest, most stable companies on the planet. This instantly gave Broadcom a steady, high-margin, recurring revenue stream. It was the perfect medicine for the unpredictable fever of the semiconductor market. A genius move to de-risk the whole business.
Okay, but just buying up these huge software companies, that wasn't the end game. For this whole thing to work, Broadcom had to show they could do more than just cash the checks. They needed to become a real strategic partner. And that brings us to pillar number 2, proving their value by solving really complex problems for their new customers.
This Verizon case study is a perfect example of how they did it. Like a lot of huge companies, Verizon was dealing with all these different departments, all with their own data, none of it talking to each other. It was slow and clunky, so Broadcom came in with its ValueOps platform, which is basically a tool designed to connect all those dots and make the whole operation more agile.
And this, right here, this is the key transformation they enabled. Broadcom software helped Verizon move away from funding hundreds of separate, disconnected projects to funding ongoing products. What that means is they could suddenly see exactly where every dollar was going and what the return was in real time. Broadcom wasn't just selling software, they were selling a whole new way to run the business.
Okay, so once you've proven your value, once your software is at the very core of how a customer operates, you've got a lot of leverage. And that brings us to the third and by far the most controversial pillar of their strategy, forcing every single customer onto a subscription-only model.
So what does that actually mean? Well, for decades, you bought big enterprise software with a perpetual license. You'd pay a huge chunk of money one time, and you basically owned that version of the software forever. Broadcom's just ended that. Now, to use their software, you have to pay a recurring fee, year after year. It fundamentally changes the economics of using their technology.
And this really breaks down that financial shift. It's a move away from CapEx, a big one-time capital expense that you can budget for, to OpEx, an ongoing operational expense that just hits your P&L every single year. For a CFO, that's a massive change. And for a lot of customers, it also came with a pretty hefty price hike.
So you have to ask, why do it? Why risk alienating your customers? Well, from Broadcom's point of view, the logic is rock solid. It creates incredibly predictable annual revenue. That's the holy grail for Wall Street. It also forces customers to stay on the newest software, which reduces Broadcom's technical debt. That's the huge cost of supporting tons of old, outdated products out in the wild. And the results? They speak for themselves. A record-breaking $12.2 billion in free cash flow in just one quarter.
So all of this brings us to the verdict. This strategy has been a home run for shareholders, no doubt about it. It's created a financial juggernaut. But it's also created a ton of friction with longtime customers who feel like they're being squeezed. So what is it? Is this strategy just genius-level financial engineering, or is it plain old corporate greed?
What you absolutely can't argue with is the result. Broadcom has successfully built this powerful and unique dual-engine business. You've got one engine just firing on all cylinders thanks to the AI boom, driving their chip sales through the roof. And then you have this other super steady engine of high-margin software revenue. It's literally the best of both worlds, explosive growth and rock-solid predictability.
But you have to wonder, is this sustainable? I mean, this approach of maximizing profits by basically forcing licensing changes and price hikes on a captive audience, it works great in the short term. But can you really grow a software business for the long haul when your customers feel like they're being held hostage?
And that, right there, is the ultimate dilemma. At what point do these massive enterprise customers who run their entire companies on this software finally revolt? Do they start looking seriously at open source options or other competitors? Or is Broadcom's platform just too good, too valuable, and too deeply embedded in everything they do to ever actually leave?
So I'll leave you with this final question. Put yourself in that boardroom. You know the incredible financial success this strategy has brought, but you also know about the backlash from your customers. If you are on the board of directors at Broadcom, what's your vote? Do you stick with this aggressive profit-first strategy, or do you change course to focus on customer loyalty? It's a classic business school case study, and there is no easy answer.